If someone froze Brindley Joinery at midnight tonight and asked what it owns, what it owes, and what is actually theirs, could you answer in 30 seconds? That single snapshot has a name, the balance sheet, formerly called the Statement of Financial Position. Welcome back to ActioFin. In this episode we build one from scratch, using Brindley's own figures. And by the end you will read a balance sheet the way an experienced bookkeeper does, at a glance. Here is our route. First, what a balance sheet actually is and why it is called a snapshot. Then the three building blocks: assets, liabilities, and equity. We meet the accounting equation, the single formula the whole document rests on. We separate current from non-current items, because timing changes everything. We build Brindley's own balance sheet, line by line. We look at the simple ratios a bank or supplier reads straight off it. And we close with the points worth remembering. The first thing to understand is timing. A balance sheet does not cover a period, the way a profit and loss account covers a whole year. It describes exactly one moment, usually midnight on the last day of the financial year. Brindley Joinery's year end is the 31st of March, so its balance sheet answers the question: what does this company own and owe on that single date? Move the clock forward one day, buy a van, pay a supplier, and the balance sheet would already look different. It is a photograph, not a film. A quick note on naming, because it confuses people reading real accounts for the first time. The current UK accounting standard, FRS 102, formally calls this document the Statement of Financial Position. Older standards, and simply everyday habit, still call it the balance sheet. And that remains the term almost everyone uses in practice, including most accountants and bankers. Both names describe exactly the same thing: assets, liabilities, and equity at one date. We will use balance sheet throughout this series because it is what you will hear far more often. But do not be thrown if a formal document uses the other term instead. Every balance sheet in the world is built from just three ingredients. Assets are everything the business owns or is owed: cash, stock of timber, machinery, money customers still owe. Liabilities are everything the business owes to someone else: supplier bills unpaid, a bank loan, VAT due to HMRC. Equity is what is left over for the owner once every liability is settled, the true net worth of the business. Learn to sort any figure into one of these three buckets and you can read any balance sheet on earth. Those three blocks are tied together by one equation: assets equal liabilities plus equity. This is where the name balance sheet comes from, because the two sides must always balance. It is not a coincidence or a target, it is a mathematical certainty. Because every transaction touches at least two figures at once. Brindley buys a delivery van with a bank loan, an asset rises. A liability rises by the same amount, and the equation still holds. Understand this equation properly and double-entry bookkeeping, which we cover next episode, stops feeling mysterious. It is worth opening up equity a little further because it is not a single homogeneous figure. For a small company like Brindley, equity is made up of share capital. The amount the owner originally invested when the company was formed, often a nominal sum like £100, plus retained earnings. The accumulated total of every year of profit that has been kept inside the business rather than paid out as dividends. Watching retained earnings grow year on year is one of the clearest signs a business is genuinely building value. Rather than simply generating turnover that disappears as fast as it arrives. Within assets and liabilities, one more split matters enormously: current versus non-current. Current means it will turn into cash, or must be paid, within 12 months. Non-current means it sits beyond that horizon. Brindley's bank balance and the money customers owe are current assets. Its workshop machinery and delivery van are non-current assets, held for years of use rather than sale. Trade creditors and VAT owed are current liabilities. The long bank loan on the workshop unit is non-current. This split is what lets a bank glance at a balance sheet and judge short-term survival separately from long-term structure. A small formatting detail that trips up anyone used to a different country's conventions. The standard UK statutory format lists non-current assets first, followed by current assets ordered from the least liquid to the most liquid. Meaning stock appears before debtors, which appears before cash itself. It then follows the same logic for liabilities. This ordering is prescribed by the Companies Act formats, and while it makes little difference to the arithmetic, it is worth recognizing. Because it differs from formats used in some other jurisdictions and can otherwise make an unfamiliar balance sheet feel harder to read than it actually is. Let us build Brindley's balance sheet for real, starting with assets at the 31st of March. The bank balance stands at £34,000. Trade debtors, meaning invoices sent to customers but not yet paid, total £58,000. Timber and hardware stock sitting in the workshop is valued at £22,000. Workshop machinery, after allowing for wear over the years, sits at £96,000 net. And the delivery van, similarly reduced for age, is worth £18,000. Add those together and total assets come to £228,000. Now the liability side. Trade creditors, the bills Brindley owes suppliers for timber and hardware already delivered, come to £41,000. VAT owed to HMRC for the current quarter stands at £12,000. Pay-as-you-earn and national insurance owed on staff wages is £6,000. And the remaining bank loan on the workshop unit itself is £90,000. Total liabilities add up to £149,000. Notice we have not touched equity yet, it falls out of the equation once the other two sides are known. Now the equation does its work. Total assets of £228,000. Minus total liabilities of £149,000, leaves equity of £79,000. That is the true net worth locked inside Brindley Joinery. What the owner would theoretically be left with if every asset were sold and every liability paid off today. It also tells us that roughly 65% of the company's assets are funded by the owner's own retained profit rather than by debt. A genuinely healthy ratio for a small manufacturer. One simple ratio, built entirely from the current section of the balance sheet, tells you more than almost any other single number. The current ratio, calculated as current assets divided by current liabilities. Brindley's current assets, bank, debtors and stock combined, total £114,000. Current liabilities total £59,000. Dividing gives a current ratio of just under 2. Meaning Brindley holds nearly twice the current assets it needs to cover everything due within the next 12 months. A bank reviewing a loan application checks this ratio almost automatically, because a figure comfortably above 1 signals genuine short-term resilience. A second useful ratio compares liabilities directly against equity, often called gearing. Brindley's total liabilities of £149,000 against equity of £79,000 gives a gearing ratio of roughly 1.9. Meaning the business currently carries almost twice as much external funding as the owner's own stake. That is manageable for a growing manufacturer with a mortgage-like loan on its workshop premises. But it is a number worth watching as the business borrows further. Because rising gearing without rising equity behind it slowly shifts risk away from the owner and onto lenders and suppliers instead. So what does this finished balance sheet actually tell us? The headline is good news. Positive equity of £79,000 means Brindley is solvent and has been building genuine value. But look closer at the short-term picture. Current liabilities, trade creditors, VAT and pay-as-you-earn, total £59,000. Current assets excluding stock, cash and debtors together, come to £92,000. That gives reasonable headroom, but a bank reviewing this would still check how quickly those debtors actually pay. Because a balance sheet showing healthy assets on paper can still hide a business waiting too long to be paid. One important limit before we finish. A balance sheet shows you the result at a single point, but it stays completely silent about the journey that produced it. It cannot tell you whether the last 12 months were profitable, whether sales grew, or how fast cash moved in and out along the way. Two businesses can show an identical balance sheet on the same date, having taken wildly different roads to get there, one steady and one erratic. To understand the story behind the snapshot, you need the profit and loss account, which is exactly where we go in episode 3. A gap worth flagging early, because we will return to it properly in episode 8 on fixed assets. The £96,000 of workshop machinery on Brindley's balance sheet is not a valuation of what those machines would fetch if sold on the open market today. It is cost less accumulated depreciation, an accounting convention for spreading a purchase price fairly across its useful life. A machine could genuinely be worth more or less than its book value at any given moment. This does not make the balance sheet wrong. It simply means readers should understand exactly what kind of number they are looking at before drawing conclusions from it. And it is one more reason an experienced bank manager always asks what stands behind a large asset figure rather than accepting it at face value alone. One balance sheet on its own tells you where you stand, but two balance sheets, this year's and last year's side by side, tell you where you are heading. This is exactly why UK statutory accounts always present a comparative column alongside the current year. If Brindley's equity has climbed from £60,000 a year ago to £79,000 now, that trajectory says something a single snapshot cannot. The business is genuinely building value, not just holding steady. Watching the current ratio and gearing move year over year, rather than judging either figure in isolation, is a habit worth building early. One more figure worth calculating directly from the balance sheet, because it sits behind so much of the cash budgeting we will cover more fully in a later ActioFin series, working capital. Simply current assets minus current liabilities. For Brindley, that is £114,000 of current assets minus £59,000 of current liabilities, leaving £55,000 of working capital. This is the genuine cushion the business has to absorb a slow-paying customer, an unexpected repair bill, or a quiet month, without needing to reach for an overdraft or delay paying a supplier it depends on. Since building this balance sheet properly, Brindley's owner has adopted a simple monthly habit that takes barely 5 minutes. He checks the current bank balance against what debtors owe, glances at how equity has moved compared to the same month last year, and notes anything unusual before it becomes a real problem. It is a small discipline, but it means the balance sheet, rather than sitting untouched in a folder until the accountant produces the annual accounts, now genuinely informs decisions throughout the year. Which is precisely the shift this whole series is trying to build in every episode. One last honest limitation worth naming. Brindley Joinery's genuine strengths, a strong local reputation built over years, a loyal base of repeat customers, and craftsmanship skills that would take a competitor years to match, carry real economic value but appear nowhere on the balance sheet at all. Accounting standards generally only recognize intangible assets like goodwill when they have actually been purchased. For instance, if Brindley itself were bought by another company. A balance sheet built entirely internally, however carefully prepared, always understates the true worth of a well-regarded small business in this specific respect. And it is worth an owner remembering that when comparing book value against what the business might genuinely be worth on sale. A small but genuinely useful cross-check that costs nothing. Comparing the fixed asset values on the balance sheet against the sums insured on the workshop's buildings and contents policy. If the balance sheet shows machinery worth £96,000 but the insurance schedule only covers £70,000 of contents, that gap is a real, uninsured risk sitting quietly unnoticed. Equally, insurance replacement value sometimes run ahead of depreciated book value, which is entirely normal and simply reflects that insurance covers replacement cost, not accounting value. Running this comparison once a year, alongside the annual accounts, has become one more habit Brindley's bookkeeper now treats as routine. 3 mistakes worth avoiding. First, confusing a healthy bank balance with a profitable year. They are not the same thing, and only the profit and loss account settles the question. Second, ignoring the current versus non-current split. Because total assets can look perfectly fine while current liabilities quietly outrun current assets, a genuine cash warning hiding in plain sight. Third, forgetting that a balance sheet is a snapshot. So one prepared 3 months ago may already be stale if trading has moved quickly since. To recap, a balance sheet is a snapshot at one precise date, never a period. It is built from only 3 blocks: assets, liabilities, and equity. Those 3 are tied together by one unbreakable equation: assets equal liabilities plus equity. And simple ratios built from those blocks: the current ratio for short-term survival, gearing for how leveraged the business is, turn a static list of figures into a genuine, quick health check that a bank or a careful owner can read in seconds. We have the snapshot. Next episode we run the film, the profit and loss account, following Brindley's revenue all the way down to net profit, and seeing exactly where the money goes along the way. The full course, with calculators and practice cases, is on ActioFin.com. See you in episode 3.